happy Finance Friday. Welcome to Finance Friday, where we try to grow your wealth, try to help you not lose money. I'm Amy Novakovich. Check me out on Twitter at NovakovichAmy, and also our company page, which posts a ton of resources at Nova Wealth Management, MGMT is abbreviated. Also our YouTube channel and our podcast, we have all kinds of things. The podcast is the Nova Wealth Show that gets like more in depth on a lot of things. So if you haven't heard, I'm going to bring your attention to it today, but there's been talk of tax cuts proposed by President Trump and the Republican Party, and they actually passed it in the House yesterday. Oh, here we go. I'm trying to pull up your comments on my live here. There you go. And so I wanted to talk about what changes they're proposing because it still has to go to the Senate, I think next month. I might be wrong on that, but it's going to the Senate yet. And there's rumors, a lot of them, maybe you've seen some of them, but that they are going to take away our retirement deductions. And in the Senate, that is what they're proposing. So whether it happens or not, I don't know, but we're going to talk about that a lot because that affects not only your tax returns this year, but also in retirement. It doesn't just affect your taxes in retirement, it affects your overall income and your investments and everything to do with it moving forward. A lot would change. So I want to take a step back for a second and just explain what Roth versus traditional means, because a lot of you are participating in a 401k and you don't even really know what that means for you. And that's kind of a huge thing for your income. It saves you a ton of money, whether it's now or later. So let's talk about that for a second. So really quick, a traditional IRA, and I know this is over explaining, and I know a lot of you know this, but some don't. So just hang in there with me just for a second. Traditional IRA or traditional 401k, you get a tax deduction for whatever you contribute, and that comes right off of your income, okay? Then the money is invested and it grows tax deferred, meaning you do not pay taxes on the money you make within the account year after year after year. And then later when you retire, when you become 70 and a half, they force you, holy cow, the smiley faces are going crazy right now. I don't even know what that is. Hey, Megan. Hi, hi, hi. And then, so when you retire at 70 and a half, you then have to pull out income. They're going to make you pull out income. And then you have to pay taxes on that income. Now, some advisors, and I saw an article the other day on this that said 401ks are a myth. And actually there's some huge people in the media, I won't say any names, that constantly tear down 401ks and IRAs and say it's a whole scam, myth, whatever, hack. I've heard it all. Here's the deal, okay? Yes, you pay taxes later in life when you retire, when you pull money out of your retirement accounts. And yes, you're forced to do it whether you need it or not. But the idea is you get the tax deduction when you're working, okay? So if I make 50 grand in a year, and I can use the board behind me here. I got a handy dandy board behind me today if you ask questions and I can illustrate. But if you make 50 grand in a year and you contributed $5,000, you now are only taxed on 45 grand. That could put you into a lower marginal tax bracket. That saves you obviously the taxes on the 5 grand as it is. And then your money grows tax deferred year after year after year. So money that should have went to taxes, hopefully you're making a lot of money, money that should have went to taxes on those gains doesn't, and then you earn money on that money. So it's like triple compounding. Okay, so again, I don't know what the deal with all these faces are. It's like they're a button stuck or something. I don't know, it's distracting. Anyway. And then later in life, the idea is you're retired, so you're making less money. That's the idea anyway. So you may not be making 50 grand, maybe you just have your Social Security. Like a lot of people I know I meet with, they just have their Social Security. Or a more extreme example, let's say you make 250 grand while you're working. And then when you retire, making 50. You know, so even though you have to pull out money, it's hopefully less in tax. All right, and not only that, but even if you are fortunate enough to make a ton of money in retirement, the idea is that you grew those funds all those years. Hopefully you started early too. You grew those funds year after year after year with money that should have went to taxes that it didn't because it was in a retirement account. Okay, so there's a lot of benefits. On a 401k, you can borrow against it. So it's an asset that you can borrow against. There's a lot of benefits. So I'm going to bust that myth for you right now. The 401k makes a ton of sense. And you can even go further on this and say any retirement plan, defined benefit plans, and I don't need to get into all the details today, but the tax bill as it stands, again, for those of you that have just joined, we're talking how the tax bill changes things in our retirement world and in our general tax world. But the proposed bill that passed the House yesterday doesn't change anything. It still has to go to the Senate. Okay, so the Senate is proposing that we take away our deduction on our traditional 401k and IRAs contributions, that we Rothify everything. So a Roth is the opposite of a traditional. A Roth, you don't get a tax deduction now, the proceeds grow tax-free, and you don't owe taxes later in life. So I hope that makes sense. Traditional, you get a deduction now, you pay tax later. Roth, you don't get a deduction now, you don't pay tax later. Okay? So the proposal is that they take away the deductions on our 401ks and our IRA contributions and our retirement plan contributions. Apparently, the numbers I hear, and who knows if it's true, my sources are, I lose confidence in all sources of media, but supposedly it would generate enough to offset all the tax cuts that they're proposing in our income. They're proposing a lot of, that we go from 7 brackets to 4 brackets, and the highest bracket would then be over $1 million of income. So our income would definitely be affected. They're saying that they would take away personal exemptions, the exemption that you claim when you go to work and you do how many exemptions? Let's put down a number. Maybe I'll claim 0, maybe I'll claim 1, maybe I'll claim 4 for my 3 kids. It's how much is, withheld from your paycheck. They're proposing they take those away and raise our standard deduction by a ton. I think they're proposing that they double it. Again, that may or may not happen depending what happens in the Senate. But the point is, what should you do right now in response to this? My answer to everybody is keep doing what you're doing. If you're doing traditional, if you're getting the tax deduction now deducted from your paycheck, or it's also known as before tax, if you're doing that now, keep doing it. Okay? If that deduction helps you, keep doing it. Because even if they were to change something, you can't make a decision guessing on if something's going to change. So keep doing it. If you feel like you don't need a tax deduction for this year, you might want to consider changing to a Roth. Whether the tax bill changes things or not. Hi guys. Hey Courtney, hey RT. Hey guys, hey everybody. So you might want to consider changing to a Roth if you do not need a tax deduction. Okay? And how do I know, Amy? How do I know? I know what you're thinking. How do I know if I need a tax deduction? Okay. Several ways you can figure that out. First of all, if you always get a huge return. All right? So that's one very generic, quick way to kind of tell maybe you don't need a deduction because you already get a huge return. You can also call up your CPA, call up your tax person and say, look, can you just quickly take a look at my return and tell me if it makes sense for me to be doing Roth instead of traditional. Maybe I don't need that deduction right now, and maybe it's smarter for me to put my money towards Roth, because that way if they do change things, you're already prepared. And not only that, but even if they don't change things, maybe you should have been doing Roth in the first place, and at least you figured something out, because that will save you a ton of money when you retire. You won't owe taxes when you retire. That sounds awesome to me. So I don't know about you, but I like to pay less money to the IRS. So definitely make that phone call. Definitely just take a look at your pay stub. If you're claiming 0 right now, if you don't know what you're claiming, you can ask your HR person. If you don't know what's being deducted from your paycheck, you can look at a pay stub. Look at a pay stub, see how much gets deducted, and then how much you actually pay on your tax return. I actually pulled out my own tax return right here. I have it right here. Because I was trying to figure out how much I'm really affected if they take away personal exemptions, if I get a higher standard deduction? Would I still itemize? That's for business owners. I don't have to get into that right now, but that would affect whether you itemize or not if they raise the standard deduction. So this is all stuff that you need to know to save you money and to know what you should be doing with your retirement funds. If you're not already contributing to a retirement fund and you want to know what to do in response to the bill, okay, I would start with a Roth just to get ahead of things. If we think that the Senate isn't going to pass it without, affecting our 401ks, then just go straight to the Roth. You won't get a tax deduction this year, but later in life, your retired self will thank you that you have saved some tax-free money that you can pull from to live on. Because what else are we going to live on? We did that. That was a different Finance Friday. Hi, Johnny. Hi, guys. We're talking about what the changes in the tax bill mean for us, okay? And in retirement, they're trying to get rid of, the Senate is, our retirement deduction. So if you have questions on this, you can always go to our resources on our website, novawealthmanagement.com, and you can always go to the Contact Us page, because that reaches out directly to us and we'll answer your questions personally if you have personal questions on what the heck to do with your retirement. Whether or not it's in response to this tax bill, not for nothing, but it's at least a reason just to check in and see if you're doing the right thing, okay? And if you don't have an accountant, feel free to just message us. And this was actually suggested, this was a topic suggested to us that we should do a while ago, just on Roth and traditional IRAs. So I'm trying to kill two birds with one stone since they just passed that bill yesterday. So that was passed in the House, for those of you that just joined. If you don't know, the tax bill, the tax cuts for income taxes were passed in the House yesterday. Okay, now they're off to the Senate, and the Senate is going to try to change some of that. They're going to try to offset the tax cuts, and the rumor is it's with our 401k dollars or with our IRA dollars. So again, how much in dollars does that really affect you? Really quickly, let's go over this example. Let's say I make $100,000. And hopefully you can see this. Yeah, okay. Make $100,000, okay? And in your 401k for the year, you contributed $10,000. And you might get a company match for that. A company match is essentially free money to you. So your company might match 3%. So in this case, you'd get a free $3,000 into your 401k. That's huge. If you have a company match and you're not contributing, you should reconsider that, whether it's Roth or traditional. That's huge. There's no other investment out there that will give you instant 100% appreciation, dollar for dollar, okay? So $100,000 minus your $10,000 that goes into the 401k, you now have $90,000 of taxable income. I don't know the tax bracket on that. I probably should have pulled that up ahead of time. But the tax bracket, let's say it's the 20%, I'm going to guess. Let's do the 20%. I'm not a CPA, so I use my resources to pull this up when I'm looking at it, my financial planning software. So 20%, okay, on $10,000 is $2,000 less in taxes, okay? Just alone from your 401k deduction. That would save you $2,000 in taxes. And this is a rough illustration, but essentially this is how it works. This is the idea, okay? So it might not be these exact numbers and my tax bracket might be off, but this is the idea. Let's just take this as a general concept, okay? So your general concept is that what you put into a traditional 401k or a traditional IRA, an IRA, your limit is, if you're under 50, is $5,500. If you're over 50, they allow you $6,500. And the limits, funny enough, have not been talked about from what I've seen, that they would change the limits. So what they're really thinking about changing is just taking away the deduction. But this is how it works. So, I mean, it's a big deal, guys. Like, you need to definitely just take the time, take 5 minutes to just see if you're doing Roth or traditional, if you have it available to you, and if you really need that deduction or not, because they're trying to make changes to it moving forward anyways. So, hey Ryan, I see you just joined. I'm just kind of wrapping up. So I'll wrap up real quick, I'll summarize. So, the tax bill passed yesterday does not change 401ks and IRA deductions. But the Senate is proposing that they would take away traditional deductions and 401k deductions, okay? And this is, again, on my example back here. If you missed it, go ahead and rewatch it for those, a couple that just joined. But what I am saying is that if they take away our ability to deduct 401k contributions and IRA deductions, then you're going to have to move to the Roth option, which would not give you a deduction now, but it would give you a deduction later in life, okay? And how you would compensate in that, there's going to be different proposed deductions. There's going to be a higher standard exemption. So you may want to look and see if you can even itemize anymore, especially if you're a business owner, if you can itemize deductions, or if you're an owner of investment property, a lot of people itemize. So there's ways that you can get around it, but what you need to do right now is just double check, and I know I've talked with several of you that are on, but double check if you should be doing Roth or traditional, if you need that deduction now. And if you don't, go with the Roth. That's as simple as it is. So as of right now, don't panic. They didn't change it yet, but we'll see what happens in the Senate, and I'll keep you updated. I'll keep you posted. I'll post some, I'll tweet some updates on what's going on, and we'll also post some updates on our website. I hope everybody has an awesome weekend. Thanks for joining. And I know I said we were going to do divorce this week. Tamara was out, and actually Jim was supposed to be here with me today. We had something going on. Something came up with the kids. As most of you know, we have 4 children. So something comes up a lot. But he was actually supposed to be here. But next week I'll have Tamara back, and we'll talk about what to do in the event of divorce or death. So 2 big life events, and what do you need to do to prepare for that, and what do you need to do after that. So we'll talk about that next week. But have an awesome weekend. Thanks for joining, and I'll see you next time.